Hi, I'm John Johnson. I'm with the Expert Advisors Home Sales Team with my company, Emptor Primus Real Estate Firm. Okay, so today what I'm going to talk about briefly is the cost of actually buying a home. A lot of people, there's a lot of misnomers going around. A lot of people hear no money down, zero down, 100% financing, and they think that they don't have to come in with any money at all. I've even had clients come through the door with a pre-qualification letter from a lender and say, they still don't understand that they have to come in with some money, right? So what I'm going to do quickly is I'm going to go over the different types of loan programs, and I'm going to explain to you the difference between a down payment and closing costs. Two separate things. People think that even if they don't have to come in with the down payment, that there won't be any closing costs associated with the loan, and that's not true. Now, mind you, I've been in the business for 14 years. For about 4 of those years, I was a loan officer, so I understand the mortgage side. And I'm not saying that this is gospel and this is 100% it. There are other programs that are available depending on the region that you stay in or what your lender may have available. But 90% of what you're going to run across is going to fall into one of these categories. Okay, so again, always refer to the experts, to your local lenders, and see what programs they have available. But this is about 90% of what I see, and this is where the trouble starts, when someone thinks that they don't have to come in with any money to purchase a home, and or they don't understand how much they'll have to come in with. Okay, so let's get started. Down payment, okay, closing costs, two separate things. Now, an FHA mortgage is a government-backed mortgage, all right, and you have to come in with 3.5% of your down payment of the amount that you're going to be borrowing. So, to make the numbers easy, if it's a $100,000 house, then you need to come in with $3,500. Okay, so every $100,000, you're going to have to come in with another 3.5% or $3,500. Okay, now, conventional programs are typically 5%. 10%, 15, and 20%, but now they have a conventional program that's floating around, depending on when you're actually seeing this, that you can come in with 3% down. Okay, so again, $100,000 loan, $3,000 for your down payment. Okay, now USDA, another government-backed loan, this loan is zero down payment. Okay, this is 100% financing. You don't have to come in with a down payment. The caveat to USDA is that it's income driven, so you have to fall under a certain parameter for household income, and it's also area driven. So logistics play a huge part of the home that will qualify for a USDA loan. Now you can go to USDA.gov, or I would Google USDA loan, and there's a site where you can go and you put the address in, and it'll give you if that home will qualify for a USDA mortgage, and also again consult your mortgage provider. The last loan I'm going to talk about here briefly is the VA loan, Veterans Administration Loan. Now, awesome program for our veterans that have fought, and protected our country, and we definitely appreciate you. This loan also is 100% financing and does not require any down payment. Okay, now, all of these loans are going to have mortgage insurance, except for conventional, unless you put down 20% and you have 20% equity in the property. The rest of these are going to have mortgage insurance and or a funding fee, or what is it with USDA? It slips me what the USDA funding fee or the additional charges with that. But all of these are going to have mortgage insurance, and I'm going to let your local lender discuss those about you, because it will affect your payment, and it will also affect potentially those fees being rolled into the loan, and or you can pay out of pocket with those. But I'm not going to, that's a whole nother video. But again, also be aware of that. Ask your lender about your primary mortgage insurance, PMI or MI mortgage insurance, okay? So these are the 4 typical loans. No down payment, 3 to 5% or 20%, however you want to structure the deal. FHA 3.5%. Okay, now here's the other part of this. This is where it gets, I would say, complicated and convoluted. Now, if you do have a program where you can come in with no money down, you still would have closing costs associated with this mortgage. So I'm going to talk about your out-of-pocket expenses that pertain to, that go along with, and are not separate from, and are separate from your down payment. Okay, so I talked about PMI a little bit. We're going to refer to the experts on that one. Now, your homeowner's insurance, you're going to have to pay for a year out of your homeowner's insurance. So whatever it costs for you to get that initial binder, whatever that year is, I always tell my clients, hey, listen, go ahead and contact whoever your auto insurance is through. Reach out to them, because they may give you a discount if you bundle. That's kind of the best way that I've seen where clients have gotten a better deal on their homeowner's insurance. Now, excuse me, your property taxes too. I'm gonna put these two together because these are going to go into an escrow account. Escrow is before the market crash, there were loans that were available that did not mandate that you pay your homeowner's insurance and your property taxes. They did not mandate that you wrap it into your mortgage payment. Well, since the crash, and there was a lot of reasons that they've gone this way. But now, if you're going to have a mortgage, 9 out of 10 times they want you to take your escrow payment, wrap it into your mortgage payment, so that at the end of the year you don't have to worry about paying your taxes or paying your insurance for a year out. They'll go ahead and they'll cut the check directly to your county assessment office and or your insurance company. So again, and to build out this escrow account, they typically want about 3 months cushion that you initially put forward into your in acquiring your loan. So those two are your escrow account. So your out-of-pocket expense is most definitely going to be your homeowner's insurance, and another out-of-pocket expense or something that's going to be calculated into your closing costs is the 3 months cushion that they want you to put in, along with the 3 months cushion of the homeowner's insurance. I know it's weird because you already are paying for a full year. Why would you still need 3 months? Again, we'll defer to the experts. We'll let the lenders talk about that. Okay, so now next, earnest deposit, your earnest money deposit. Earnest money is where you put this good faith money to say, hey, we're really serious about purchasing this property. We're going to go ahead and put down $500, $1,000, $2,000, $10,000, whatever that is, whatever you feel comfortable with. And that's something you and your real estate agent can go over, and whatever you guys feel comfortable with. And that the earnest money, I always say, is like this. It's something where you kind of want to, you're kind of holding your feet to the fire in the sense that you're showing that the seller that you're very serious about purchasing the property, and if outside of the contingencies that you have placed within your contract, that you just don't get to the day right before closing and say, you know what, I don't want it, and you've wasted their time, and then they can confiscate the earnest money for the time that you've wasted. Now, that's a whole nother video. I'm not going to get into that, but again, that is earnest money, and that is good faith money, and you don't always have to put down earnest money, but in today's market, especially here in Atlanta, you know, we're trending at about 3.5 months, about 3.5 months worth of reserves, which means that it's a seller's market. So you don't want to write a weak offer and miss out on your dream home. So you definitely want to, you know, be fair, right? If you imagine if you were selling a house and somebody, you know, didn't want to put down any earnest money, and that's not standard. So you want to be fair with that. Okay, so that's the earnest deposit. That's going to come out of your pocket. That can either be done 2 ways. One, you can either submit it with your offer, or for myself, what I do for my clients is I say, you know what, let's do this. Let's get everything negotiated. I'll send the contract over without any earnest money, but we'll say 2 days afterwards, once we come to terms with everything, then we'll deposit the earnest money. And that seems to be fair. All right. So the next part is closing attorney. Right? So the closing attorney, and again, some states have, I've been licensed in 2 other states outside of Georgia, and in some states they have closing attorneys, other states they just have a title company. Same difference, they just kind of sit down with you, go over all the paperwork, sign the note, the mortgage, the deed, go over everything with you, register everything with the county so that the property transfers over into your name. They check for liens and title encumbrances, and so the fees that they charge, here it's typically, I see between like $1,000 and $1,500. Again, that's going to vary by closing attorney, that's going to vary by state, and et cetera. Some I heard across the country are a lot more than that, and some are on par with that, and some are not that much. But typically it's about $1,000 to $1,500, you know, where the area that we're in. So another thing that you're going to want, I always advise this, it is optional. It seems to be trending about $300 to $400. It's title insurance. And what that means is that the closing attorney has gone over the deed, they checked the property, there's no other potential liens or encumbrances on the property that you're not paying off at the time that you purchased the home. But what it says is that, let's say that they missed something, and then, you know, 6 months down the road, let's say they put windows in the house and they never paid the guy to do it. The guy filed a mechanics lien. It didn't show up until 6 months later after you've purchased the property, and that lien is attached to the property itself and not the other sellers, which are long gone. You would be responsible for that because it's now attached to the property. Well, title insurance says that, guess what? Hey, Mr. Window Installer, you can't come after me. You need to go after the closing attorney because they missed it. It's their responsibility. I have this title insurance, and it remains on the house until you sell it. So if it's 20, 30, 40 years on down the road, you know, that title insurance will always be in play, okay? $300-400, peace of mind, go ahead and get it. Again, another out-of-pocket expense or another closing cost. Okay, so origination fee. Origination fee is what your lender will charge you to originate the loan. Okay, some places charge 1%, some places I believe they can still charge up to 3%. Again, defer to your lender for that. Some of them don't even have an origination fee. You know, I'm just, again, that's lender specific. Talk to them about that, but that is the fee that they are going to charge you to process the loan, package everything, you know, send it through underwriting, get it approved, and get the funds to closing for you to purchase your home. The appraisal fee, okay? Here, on average, depending on the size of the home, if it's under 5,000 square feet, I think we're averaging about $450. Most times, this is not always to be paid prior to closing, but 9 out of 10 times it is, okay? And so the lender may credit you, they may make you pay up front for it and then credit you on the tail end of the loan, or you just may have to pay for it outright, or they may be able to have something where the appraiser gets paid after closing. They get a check cut from funds from the closing. So again, that's up in the air. Talk to your lender about that. They'll tell you what their practices are when it comes to ordering appraisals, okay? But that fee is typically about $450, $500, you know, give or take. State recording fees. That's whatever the state is going to charge you to say, hey, we've received the information and we're putting the house in your name. We're changing all of our deeds and records over to, you know, to your name. Again, this is going to be state specific, county specific. I mean, those fees are all over the place. Okay, so I believe here we're about $200 or $300, give or take. And again, I'm not a closing attorney, nor do I work for a state or anything like that. So my numbers are, you know, they're not pinpoint, but I'm trying to give you a broad overview. Again, speak to your lender, talk to your closing attorney, and have them go over these numbers with you, and which you will get a disclosure prior to closing, which will have all these numbers broken down, okay? And also, always feel free to reach out to me if you have any questions or concerns. I mean, I can pinpoint the numbers, just give me a call, regardless of wherever you are in the country. I've worked for the banks, I've worked for the lenders, been in the business for 14 years. I've worked for, you know, 2 of the large banks, and I've helped do some of the foreclosure audits and different things like that. And so I've had to deal with attorneys in different states throughout the country. And so I kind of know my way around those avenues. So if you need something, give me a call, shoot me a message, or whatever I can do to assist you, I'd be more than glad to help, okay? Your interest, okay? Now, interest is, so let's say that you're closing the loan on June 15th, okay? So the lender is going to want you to pay from June 15th to July 1st the interest, all right? And so let's say the interest for that month is $400. They're going to want you to pay $200 because they want the remaining interest on the loan. They're not going to look for principal. And 9 out of 10 times what'll happen is that you pay that interest for those 2 weeks, and then you'll have the next month off. How they calculate that, I have no clue. Again, refer to the experts on that, but that's typically how it goes. So that, again, is going to be wrapped into a part of your closing costs, okay? Now, HOA. So if you have a homeowners association, okay, some of them have initiation fees. I've seen it go from gated communities here, gated communities, golf course communities here in the area that my office is located. They're about $1,300 for initiation and about $1,300 a year for the HOA fee, okay? So they may have a situation where the initiation fee will cover you for the rest of the year or the rest of the term, or they may have an initiation fee and they want you to pay the remainder of the year. So if you're coming in, you know, you're closing mid-year, they want you to pay the remainder of the 6 months. So in that case, it would be another $650 for the remainder of the 6 months, okay? But that will be a part of your closing costs, is paying the initiation fee, and also, and now mind you, not every homeowners association has fees, right? Most of them do, and that seems to vary by the level of what do they provide to the community. You know, obviously if it's just cutting grass around the clubhouse, then obviously that's going to be a lot cheaper. I don't want to scare people away from HOAs because some of them are just $200 a year, and it's just for them like sign maintenance and making sure the common areas are kept up. So again, talk to your real estate agent, have them pull the bylaws. Even prior to making an offer on a property, have them pull the bylaws, get that over to you so you guys can go over everything, where to tell you exactly what the restrictions are and the fees that are associated with that. Another thing that I'm running across, not all the time, but here and there, is there's a clearance letter. So the lender wants to know, because of the crash, and there were a lot of HOAs that were taking the money and weren't doing what they were supposed to do. So, and that was causing a lot of havoc with the association. So what the lender says is now is, hey, guess what? With this homeowners association, we want to make sure that they're solvent. We want to make sure that they've got all their I's dotted and their T's crossed and everything is good. and that the person that's selling the home, that they don't have any back fees due. Okay, so in order for them to provide the letter of, hey, everything's all good, we're all good, the seller was all good, doesn't owe us anything, and we are solvent, to provide that letter to the lender for them to sign off on the loan, some of these HOA communities are charging $150, $250. You know, there's one over here that there's a company that every HOA that they do the admin for, they're charging $250 just to send a letter out. Oh, and word to the wise, if you happen to need one of these letters to secure your loan, order it as soon as possible. Okay, because what happens is if you don't order this and you delay on this, they're charging an additional $150 or $200 or something like that to have a rush. Now, rush means instead of 7 to 10 business days, we can get it to you in 3 to 5, and it's an additional $150 and $200. You know, not a lot of money, but still unnecessary if you are timely about the time that you're ordering that. Okay, so these are, and mind you, there's going to be some things that are going to be in addition to additional closing costs that I haven't covered here. I think I pretty much got everything. But this should definitely give you an understanding as to what's going on. Now, closing costs, I do want to say this. Closing costs do not have to be an out-of-pocket expense. If you got a great realtor, such as myself, right? Hey, or if you do have a great realtor and they can get a seller concession, a seller closing cost credit from the seller, they can assist in these fees. Typically, closing costs are between 3 and 5% of the total loan amount. So again, $100,000 loan, $3,500. You can say, hey, Mr. Seller, I'll buy your house. However, can you please give me $3,500 in closing cost credits? And if they say yes, then these can be, debited from the seller and credited to you, so you don't have to come out of pocket for them. Now, some of these things, even if you do get a closing cost credit, if it's, let's say your closing costs are $5,000 and you can only get a $3,500 credit, obviously you'll have to come in with the additional $1,500. Now, but your earnest money will still have to come out of your pocket, and a lot of times your appraisal will still have to come out of your pocket, all right? And also, I always advise everyone out there to make sure that you get a home inspection. Now, the home inspection is going to be on you, the buyer, right? And you want your own home inspection. You don't want the seller paying somebody, because they may be underhanded. Not saying that this is typical, but they may be underhanded. You don't want them to pay for it, because if they pay for it, they might give the guy extra $100 to say, hey, the house is just fine, right? And so if you get a home inspection, those typically here are between $300 and $500, maybe $600, depending on the size of the home. But it's a great opportunity to see what all problems could prevail with the home. So home inspection, that'll be an out-of-pocket cost as well, okay? So, again, just try to give you a high-level overview. This is running a little long. I'm going to get out of here. But if you have any questions, any concerns, even for other agents, I know a lot of agents don't necessarily know the technical breakdown of these things. Any potential clients, and again, whoever you are across the country, give me a call, shoot me a message. I'll go further into this. Or if you have anything, any questions about buying a home, selling a home, or there's any service I can provide to you, please do not hesitate to call. Again, my name is John Johnson. I'm with Expert Advisors Home Sales Team with my company, Empty Primus Real Estate Firm. Thanks.